Good morning, everybody. Welcome to the Flow Show. Fed Day. Here we are, the biggest Fed day since the last biggest Fed day and the last biggest ECB day and every other big day that we go through. Hope you're all doing well this morning. Morning, Keyman. You all fitting well?
Good morning, Ryan. Good morning, everybody. Yes, we are doing fine, mate. We're doing fine. We are now looking at the other side of the day. Yesterday we woke up at untold hour, and now we have to stay up for a little bit longer after our session for the Fed today. But it's good that the Americans are still like an hour earlier, so we don't have to wait for too long.
No, exactly. And we get a nice early FOMC this morning, and I certainly feel a touch more awake than I did yesterday morning when doing a Flow Show, having already been up 8.5 hours. But fit and ready to go. So we shall get stuck into it. Lots to talk about regarding the Fed, obviously. Over in Japan, they closed for holiday today, but we've had Mr. Yen, as he's called, if I can get his name right, Isuki Sakakibara, coming out. He's the equivalent of Kanda at the moment in terms of official FX man. He says that officials could intervene if the yen falls to something like 155 to 160. That's quite a way up, but that's when he sees them possibly intervening. Says the yen could, though, rise to 130 by the end of this year or early next year. As you can see from the chart there, we are on a big, interesting level. This is the big one, the 152. We've been here 3 times, or this will be the 3rd time we've been here. There's been intervention around each of those moves. So my viewpoint on this one is that it is potentially a line that officials don't want the yen to cross. They never put a number on it. As you all know from prior times we've spoken about this, they tend to look at the volatility of the moves and whether they reflect fundamentals, speculation, so on and so forth. But the fact that they have acted up around here twice now lends some suspicion that they see this number as a bit of a level. So certainly after the BOJ and the moves we've seen so far, intervention is coming front and centered as a big risk to the dollar yen or yen in general at the moment. So we have to be careful. Ordinarily, I'm already long, but ordinarily I might think about putting a buy stop through that 152 if it breaks. But that intervention risk, I'm just gonna sit on my hands and manage what I've got for now and see what it wants to do. But the higher we go, I think the greater the intervention risk grows. What are your thoughts, Kay?
Yeah, speed up. Speed, as I've been saying, the even if he's not there anymore, Kuroda's lines are still resonating in my head. Several or a couple of sessions of 200-300 points higher in the dollar yen, weakening of the yen is excessive. Even if he's not there anymore, I think they may still, or we should still keep it in mind. The issue is with the yen right now is that it's okay. The rest of the dollars is relatively big. We can say that, but the yen is absolutely getting hammered versus everything now. It's the global yen level is coming down very, very rapidly, and I was just talking about it with Rick in our Flowonomics room. It's not only the dollar yen that we have to look at, but you have to look at those yen levels as well. Even though they can go lower still, they probably will go lower if they don't do anything. But we can't rule out if we see, for instance, the FOMC tonight being a little hawkish dollars and we start to fly through 152. I've got a bit of a suspicion there's not only stops but even barriers, and those can be real accelerators if it goes through. Then if we end up at why not 154, 155, that tomorrow they come in, because it's just going too fast. But But of course, again, if this is a grind and if the rest of the dollars remain a bid, there's very little they can do in the medium term. So we are going to be faced with the same problem as we had before. That is intervening, okay, but if you come into an environment where the dollar is bid, it's going to last for the time of the interventions, a couple of sessions more, because the people are a bit in shock, and then we are going to get back to the levels where we are. So that, I think, is the situation now. There's a lot depending on what happens in the dollar in the next few sessions, you know. But and as I was also saying regarding interventions, imagine that the dollar turns around versus the rest. Like, you just imagine that Powell is a bit dovish despite what the market is expecting, and we see a bit of a dump in the dollar, but then you see the rest of the yen crosses continue to rise and the dollar yen being sticky here. They may not even wait until 154, 155. They may look at this yen level and see it much too low compared to their expectations. I think they must be a bit surprised with the size of the move, though, that we had since the Bank of Japan. So I wouldn't rule much out. But of course, if it flies away straight to 154, 155, then we need to be ultra vigilant, in my opinion.
Yeah, very much so. I'm going to have a look, because we have to look at the probably the trade weighted numbers as well.
Exactly.
I'll have to look to see where those are.
They're down in the toilet.
Yeah, because the officials, the BOJ, will be looking at the trade weightage. It's not just dollar yen; it's what's yen doing as a whole, if you like. And we were on very low levels in that TWI, so I'll have to get back to looking at that one. I know our good mate Father Ted in the chat room keeps an eye on those as well, so I'll have to give him a nudge to get his charts out again. Right. Anyway. Moving on, we talk about prices in a bit more in a moment. Over in China, they kept their LPR loan prime rate unchanged, as was largely expected. 1 year still at 3.45, 5 year at 3.95. China's Wang says he's willing to deepen ties with Australia and willing to restore the dialogue mechanism. So further conciliatory talks going on with those guys. Coming over to the UK, and a bit of good news for the BOE, depending on how you want to look at it. There was a report from Expert HR, which is a human resources publication, saying that the median pay forecast for UK companies fell to 4%. That's a 2024 pay forecast fell to 4%. That comes versus 6% seen last year. So firms' expectations for how high they might have to raise wages are coming to 4% now. So that's coming a little bit softer. We've still got heavy or high wage numbers coming in the jobs data. So that's an influence for the Bank of England. Obviously, we had the data today. UK. Oh, I've got on the right thing. Let's have a look. Where are we? There we go. So a ton of price data from the UK. Oh, come on, give it that crap. There we go. So CPI coming in lower than expected. Headline CPI at 3.4%, a pip lower than expected. Core also coming in a pip lower, 4.5%. So there was much back-patting going on by the Chancellor, talking about inflation. That's what they need for an election year. He was citing that the low inflation increases the hopes that the Bank of England can start cutting rates, which will be a good election pick-me-up, shall we say, for Rishi Sunak. Some of the other data also coming in a bit mixed. Year-on-year PPI, core PPI up 0.3% from a prior 0.3% on the month, coming in plus as well, but not as much as expected. RPI coming in, that's the retail price index, coming in a little bit softer there as well. PPI input numbers, as expected, a minus 2.7%. So seeing a negative trend coming in for input prices on PPI. But on the other side, output prices were higher than expected. Expected to come in minus 0.1, came in plus 0.4% year on year. So these output prices, so if you imagine input prices are what factories are paying for materials and the like, output prices is what they're then charging for their finished products. So there's still a bit of disparity there where people are still charging higher and higher prices for what they're selling. So you can think of this in two aspects. One on the inflationary aspect, that there's still inflation towards the end of the chain, i.e. where people are buying products and the like, but costs to those people making those products are coming down. So it's good in one sense, bad in another. It keeps inflation sticky, but there's also a potential profit margin improvement there. If you're paying less for your input costs and charging more for your output for what you sell, then you're going to be making more money. So on that sense, it's positive for the economy, even if it means slightly negative for inflation in terms of keeping that sticky. Now, overall, what that data's done is it's firmed up rate cut expectations. Rate futures now see 71 basis points of cuts by the end of the year compared to 67 points of cuts before the data. It's only a 4-pip move, so not really a big change, but it's getting up towards 3 cuts in effect before the end of the year. We have fully priced August as when the first cut will come, so that hasn't really changed. Again, it was only a small marginal change. We were pretty much priced in August. Now we're sort of fully priced in August, so no change there. It all depends now on whether we get a change in votes from the BOE, whether some of those 2 hawks still voting for hikes move into neutral. I shouldn't think we get anyone joining the cut brigade, and that's Dingra as the holdout for cuts. But that is a bit of a risk now, just to start indicating that a few people are now seeing rate cuts more likely than staying on hold or rate hikes. So yeah, I think the risk tomorrow is whether we get something that's a bit more dovish than the market's expecting regarding the timing of the first cuts.
Right.
Yeah.
Don't you think that Bailey is a risk of sliding into a more dovish on the vote side?
Yeah, that's what I mean. It is possible that he paints a, I wouldn't say dovish picture, but less hawkish picture.
Yeah,
if you know what I mean.
That's what I mean. But he could slip. He could start to slip a little bit, right?
Yeah, start indicating, yep, inflation is coming down. We're going to be cutting. We don't have to wait for inflation to get there before we start cutting. If we think it's picking up, disinflation is picking up speed, then we look at cuts. Yeah, he can put a bit more of a dovish slant on it. I think that, as I say, that is the risk. And I think the risk is that they may indicate they could go earlier than August. If they even mention June, then, I don't care what people say about central banks not all talking together. They will put them right in line with everyone else, and will indicate that they are perhaps looking at all moving at the same time just to keep things contained. But yeah, we didn't get the biggest move in the quid. I thought we might get a bit more on that. It seems we're constantly disappointed at the moment by price moves when things don't come in as expected. We saw that with the Bank of Japan yesterday. When their confirmation of their hike only brought a 20 pip move. Similar today in the quid. As I say, the price expectations haven't moved around too much. We're only up 4 pips in expected cuts this year, and I think we went from 95 to nearly 100% in August expectations. So perhaps that's why we haven't seen a big move in the quid. Even quid gaining against the euro smalls. Why is that, Kay? Just this lower vol we're seeing at the moment, or market reasonably priced?
We had the same thing on the Canada. You had the initial move yesterday on the lower Canadian data, and then it kind of came back to where we were before. We are seeing this more and more, and vol, one thing. The other thing is as well is that the market is coming or trying to come to a conclusion, or as we've been saying, that June is going to be the month of everything. But then if you assume, and I'm talking not us in particular, but really the guys who are handling the big money, if they assume that June is the month where everybody moves, and everybody moves at the same speed, your differentials are likely not going to move a lot. And that means that if you translate that then to a currency, yes, there will still be disparities on the rates. And I think that's something that then we are seeing, for instance, on the quid today, because the sterling is at what, 5.5, yeah? And then you still end up with a small interest rate differential. So the sterling, for instance, is not doing too badly. Canadian yesterday was a bit of an example as well, although the dollar CAD is a bit higher, but all the dollars are higher today. But that's the thing. If you're sitting in an asset manager also, and you're managing portfolios, and your portfolios are X% of this bond and X% of that currency, and if your outlook is for everybody is moving at the same time, thus the interest rates differentials will be remaining the same, then you're actually you don't have to manage too much in your currency portfolio, right?
Yeah, very much so, very much so. So it's all
that I think is somewhere behind those moves that we see, and I mean the lack of the moves that we see, and then the low volatility environment in FX is the other side, because you do a move and then that's I think the reason also why dollar CAD did not continue yesterday, is that with the low volatility, you can imagine that we're trading 135.5 and you buy a 136 call. Once it goes over 136, your option is worth a bit more, your delta is increasing, so you start to be on the other side. Even though you think it's going higher, your portfolio tells you that you need to start selling dollar Canada, and that's what low volatility does. It creates a move, and then you find people on the other side of the range, because they need to hedge their stuff. So, but I mean, it's a slow. Seems to be a slow grind, but today, today the UK numbers, they came in roughly as expected, right? So a little higher the expectations for the number of BPs in cuts, affected cable a bit with the rest of the dollars, but then it doesn't affect sterling crosses at all. Actually, sterling is doing a bit better on the crosses.
Yeah, exactly. So a bit of a different reaction to what you might expect. I just want to go to Ali's point. He says the UK inflation is not too much weak, and if it surprises to the upside like the US, it's not holding. The US is far stickier. If you look at the chart of the US, you'll see that since June last year, it's just been around 3% and just gone sideways. I showed that chart a week or so ago. A couple of weeks ago. UK inflation is always likely to be more sticky. I'm surprised we're getting down to these levels. There is the potential for more fallout because of the energy price cuts that will be coming in starting April. So that might be another negative for inflation. The question is where does it start settling? It looked like it might be start settling around 4%, but then we've had that print today. It brings it down. I think we could expect a bit more volatility in UK inflation than we got elsewhere, but how fast it keeps falling, I'm not so sure. If we start seeing wages coming down, that's one of the big sticking points that we've got at the moment. Higher wages, if they start coming down, then inflation is probably going to keep going, and if it picks up speed, that will force the Bank of England to start cutting sooner and maybe faster. In just the same way they went higher than most people expected, they might be a little bit at risk of having to cut more than some of the others, just the way it's higher volatility here in the UK. But we'll keep an eye on that. They still again, a bit like the Fed, they've got higher rates than the ECB, so there is perhaps more inclination to cut a bit faster than the ECB may need to, from being up those lofty 5.25% level. But yeah, it's not looking that sticky at the moment, Ali, after this report, but we'll keep an eye on it as the data comes out. Right, just quickly on the data, Germany PPI there as well, so still negative numbers coming in there on the month, more lower than expected. Same on the year, bigger miss there, minus 4.1%. So again, seeing might be getting towards some bit of deflationary type scenario in Germany rather than disinflationary. But these PPI numbers can be quite volatile at times. While we're in Europe, the ECB's Kazakh says he's comfortable with the current market pricing on rates. Says that moving at forecast meetings is more straightforward. So keeping those rate moves to those forecast meetings. Says we'll take some time to get to the neutral rate. ECB's De Guindos pretty much stealing the lines from his boss, saying the ECB will have far more data at the June decision. He's been a June man in the main. ECB's Makhlouf says hopeful that the ECB rates are now at the top of the ladder. Yep, you better hope that. Lagarde was out at some conference or another earlier. A lot of her comments pretty much rinse and repeat from the last ECB statement. Said we need to move further along the disinflationary path, watching wages, profit margins and productivity growth. Latest wage data points in an encouraging direction. But says, given the delays with which data becomes available, we cannot wait until we have all the relevant information. That was a bit of a little bit of a dovish comment there, saying that despite them all being data dependent, they may not be able to wait to get all the data that they need before thinking about cuts. That's a hint at maybe getting a cut sooner rather than expected, or when they feel like it rather than whether the data confirms it. So services inflation may remain elevated for most of the year, and even after the first cut, we can't pre-commit to a rate path. We had some ECB sources piece out as well, saying that the data will decide the frequency of further moves after the first rate cut, not really anything we didn't already know. Over to yesterday's data, which I haven't got up yet, so I need to click that and click that. Bit of data out of the US and Canada, as Kate mentioned, CPI from Canada, again, coming in lower than expected. We got a ton of measures from those. So the headline CPI coming in at 2.8%. So was expected to rise 2 pips, but ended up falling a pip over January's numbers. And then some of the core measures as well coming in softer than expected too. So a bit of a surprise there for the Bank of Canada. Dollar CAD did have a little go at 136. Spent a few moments sitting above it. Bit of a prior highs that we had up here, got up to the lofty highs of 13.14 before then falling all the way back to 135.50. Okay, I was probably half asleep for that move. What was anything in the pipe that caused that sudden drop from up there to?
No, I think positioning, and I think what I said before, you're finding probably people trying to buy the break and then finding offers, option-related offers also on top, and then a bit too many dollars. Don't want to keep it in the short term. I myself, I tried it and I gave up, but I'm quite keen on looking to get back into. I must say, for as long as like 135.5 or something there holds around. Yeah, I think it's more to do with that, you know, get a move and then it fizzles out again. We've seen that on many currencies. We saw it yesterday on the RBA as well. You know, we had a 50-point move down on the nearly 60-point move down on the Aussie, and then we came back into the middle sort of later in the day. It's happening a lot on those currencies, and that's likely because it's too cheap to buy options, so the people do it, and but then to get their premium back, they are sitting on both sides of the ranges. Yeah, I think all in all, coming back to you, because you were on the dollar CAD, coming back to 136 is probably positive on the Aussie as well, where you are now. Sorry.
You got me running around. Go on.
I'm toying with you, huh? No, on the Aussie as well, where you are now, we are still topping out at the top end of that box. We have been looking at that box for ages, 65.40 around. The daily cloud is also coming off, so that is, in my opinion, still good for to weigh on the Aussie. We need to get back above. We need to get back above that that box and then the cloud, which is in the 50s around, to go back more neutral also on the Aussie dollar. Yeah, and I guess that unless you want to trade about something else, talk about something else that brings us already to the FOMC, or you want to talk about something different? Oh, okay. Ryan disappeared. We don't hear you, mate.
Oh, sorry, mate. I've muted me mic. Yeah, we had starts and permits from the US, which were pretty positive as well. So that keeps the housing market ticking along. Just for the Fed, traders now see a 75% chance of the Fed hiking in June versus 50% that was expected on Monday. So we've already seen a bit of a hawkish shift going on there. Oil traders just need to keep an eye on headlines because Ukraine had hit Russia refineries with drone strikes, apparently knocking out some 900 million barrels, 900,000 barrels per day capacity from those refineries. So we've seen oil going a bit on the bid side at the moment, but if we get further headlines like that, then we're going to see oil remain in bid when things happen to oil. So just keep an eye on that. But yeah, that's it from the headline front. Unless you got anything else, Kay?
No. We can move on. Just want to say quickly on Ali, you're still keeping your euro sterling short. It looks actually a bit more promising now than I thought before those CPI numbers. I thought there was a real risk of all of a sudden a bit lower CPI numbers hitting the sterling, but sterling is behaving pretty well. And as Angela says, if you think that the dollar picks up momentum, it's probably not going to matter much between the Aussie and the euro. I myself, I'm in the Aussie right now, but I'm not a bull euro either. You know, I think we find offers on rallies in the euro dollar as well, unless we get a surprise, of course, out of the FOMC later. Yeah, as Angela said, they're probably all going to go at the same time. There's one in particular that I'm still in via my options, is that dollar Swiss, because we have S&P as well tomorrow morning, and the combination of FOMC, S&P, if we get a surprise out of there, could be a bit inflammatory for the dollar Swiss.
Yeah, very much so. Gavin just saying that, to talk about the loonie again. Yeah, those weekly highs, 136 taken. Yeah, certainly it cracks the egg, as I like to say. You know, we had that pretty solid level up there. It's cracked the egg, and here we go again, having another move into it. So price action suggests that we might be moving on higher. Have a quick look at that. Where can we go from here? 136.5 has been a big old level. Going back, it's been one of those, as you can see there. We've always had a bit of action around there, so that we haven't been there for a while. Since the latter part of last year, so that's my next level, 136.50 for the loonie, and then further out, if we get up towards the 138s, even towards the high 138s, is some big levels up there. So, yep, it's all open to play for the Fed. Horatio, yeah, 75%, roughly 75% chance, those expectations for the Fed to cut in June. Right, so on to the Fed we go, and what's expected. For those of you in the chat room, I've put I've just put together a lot of the bank institutional forecasts and thoughts for the FOMC. What I'm sensing is that there's a lot of increased hawkishness coming around. Lots of people citing the risk that they may move to indicating 2 cuts only rather than the 3 that they projected in the dot plots. These dot plots are going to be important. This is the dots at the last meeting. So as you can see, 2024, the medium coming in around, indicating 3 cuts in around there. So people saying that, it's only going to take a couple of dots from down here to move up there, and it changes the landscape from 3 cuts to 2 cuts. The dots are obviously going to be important. Whether it's 3, whether it's 2, I think is important for short-term price moves, just as whether the Fed are going to indicate they're less confident of inflation getting back to target. If you remember the FOMC in December, Powell said they are closer to being confident. Well, now they might be a bit further away given those last inflation numbers. So that's what we're going to be trading around into the meeting. Obviously, keep an eye on the further out dot plots. They don't mean a huge amount right now because everyone's focused on this year. But unless there's a significant move up, if there is a significant move up, then that might get the market looking as well. This, for me, is maybe the more important of the dots, the longer run. My thoughts on this were sparked by Mester saying that she may move her longer run expectations higher. Effectively, what this is where the Fed see their neutral rate. We always talk about the neutral rate, or central banks talk about the neutral rate. That's the level in which they think rates will settle at when everything's normal, calm down and whatever. And from that point, they can hike, cut as economies require. So if this starts moving up a bit, and there's some expectations it could move up as high as 3% for the median, which is currently at 2.5, that is going to be a bit of a hawkish move. The reason it's a hawkish move is because of this will encourage flows, okay, for the longer investor, okay, not your people who are trading around these dots, today. If you get an example like the ECB, if they see their neutral rate at 2%, they're going to cut, roughly 200 basis points. If the Fed see theirs at 3%, they're going to be 100 pips above the ECB. So there's still going to be a policy divergence gap. And if you are an investor who likes chasing yield, you're going to go for 3% over 2%. And it's these types of indicators that drive the longer term money, where a rate's going to stay higher for longer. And if it's going to be the Fed, that's where we'll keep the dollar supported, because that will be where the flows go to just to chase that extra yield. Now, the caveat for this is that obviously no one knows what's going to happen in 4 years, 3 years, 4 years, whatever it is. Economies can change, but it's the impression it gives now. Okay, and if the data plays into that forecast, then you're going to see those flows appearing, and the money, the tide of money swashing around the globe will go where there's higher yield. It always does. So that for me is the bigger risk here. Personally, I expect Powell yet to pay some attention to that higher CPI, that stickier CPI data. But as we've been noting on the flow show, there have been several consumer indicators that have maybe just started to wave a yellow flag. It's not conclusive yet, but we've noticed retail sales, the last 2 reports weren't good. We had a bad one in December, an improvement in January, but once you stripped out all the big stuff, the core numbers were still pretty soft. I think they were flat. So no real improvement in the consumer. Consumer confidence numbers have fallen. So there are a few indications that maybe the consumer's up for a wobble, yet to be decided. So I think there's a risk that the market's a bit too hawkish going into this one, and Powell will, even if he just walks down the middle of the road, that'll be less hawkish than the market's expecting. So balance of risk for me is that we maybe get a bit of a dollar pop if he has a moan up about sticky inflation. But he will likely counter that with maybe some warnings about the economy, and that will see any dollar rallies maybe twisted around as those expecting 2 cuts find that they're still only going to get 3. So that's my thoughts. Kay, what are you looking at today?
No, I also think that there's always little risk when people start to go a little bit too much on the one to the other side compared to the other side of the spectrum. Powell is probably going to walk his usual lines, that is on both sides of the neutral. We've seen over the meetings that we had that he uses those press conferences to really highlight everything that he possibly can. So on the dots is of course what we are going to look at. Then there's a bit of because they they said that they would start to talk about how QT should evolve as well. So we may have a little bit of talk about that. But if we keep it to the dots, there is a bit of a chance that the whole dots field moves up a little bit. I can't believe that in the long run they are going to go straight from 2.5 to 3. That's a massive move. That is really a massive move.
Yeah.
I mean, if you go from 2.5 to 2.625, that's already a move. From 2.5 to 3, that's a crazy move. I can't believe in it. But there is a bit of a risk that we're seeing some shift higher in the 2024, but the 2025 is also going to be important if we see a bit more concentration towards the top end or closer to 4%, let's say. That's also going to be important. So that's things that we need to watch. So where we are now, I think the market needs confirmation of its own more hawkish approach to what the yields or what the dot plots could show. Okay, and then it's up to Powell to tell us. But I think, well, I don't like to say that, but I think it's once we know the dots, the rest could be absolutely irrelevant what's happening later today. And Powell can say what he likes. It's not going to change much, unless he goes like, yeah, June is not a certainty. If he really says those words, but that would counter what he's been saying up to now. Is that the confidence levels are going up? So to prepare us for June. So that would counter it, right? But yeah, I think once we know the dots roughly, the rest is going to be, if Powell steers the course, it's going to be irrelevant, the rest. And I hope we get it so we don't have to listen to everything.
Yeah, no, I agree with that. I mean, yeah, it's probably the 2025, 2026. If the 2024 moves up, it's going to be mechanical that some of those move up. Okay, so that's why it's not that much of a big deal whether these dots move up. Obviously, if these dots move up while these stay the same, yeah, that's something different. But if these move up in 2024, as I say, it's going to be a bit mechanical that those will move up as well. But yeah, it was one of the I can't remember which one. One of the banks said it could go up the longer run to 3%. I think that's a move too far personally as well. But we shall wait and see. For the dollar and trading it, because my view is that the market is maybe a little bit too hawkish about this one. That would suggest that the price risk, and as the ratio says, 75% chance from 50% of a June cut is quite a hawkish shift. So it leaves the price risk, if they're not as hawkish as the market expects, then we're going to see the dollar get sold off. And I don't think they can be really, really hawkish. Worried, yeah, more hawkish. It's not as if we're going to start switching to rate hikes unless inflation really does take off again. So in those terms, I'm favouring selling a rally in the dollar. Euro dollar is probably going to be my favourite pair to do that in. I think a lot of this move down has been just as we've ramped up into the Fed stuff and this hawkish twist. We're pretty much holding the give or take the 50 fib down here. So I think if we're going to move down maybe to the 108 on the back of a Fed, giving the market what it wants or indicating stickiness in inflation and not confident, That's the area I'll be looking at, 108, 107.90, maybe to add back into some longs that I'm already sitting in, but that would be my favoured one. As I say, dollar yen could be a bit of a dangerous one. I'm long. I'm just going to manage what I've got, I think, in this one. But again, I might favour buying a decent dip. We've got this broken level here, 150.80s, 150 the big figure as well. So yeah, I might look at that one just to give it a go. But heightened intervention risk is what's got me cautious about this one. So that's what I'm looking at. Kay, what are you got any ones you're picking?
Yeah, just stay on that one. I think the 150-190 figure is going to be important. I've got slight impression specifically on the yen, and also looking at the yen crosses, that it actually not going, and unless those dots remain the same and Powell goes dovish, but it won't matter too much. I think the 152 gets taken out sooner or later. I've got the impression there's just too much to do over there. So I was long, as I said yesterday, after the Bank of Japan, but I also bought an option. I started to hedge my option a little bit, just in case that it goes back down. I'm running a 150.5, which is doing pretty nicely. But I'm still a bit under hedged. The one where I'm 50-50 hedged right now, because that is the dollar Swiss. That is because of the combination FOMC S&P. We are turning around a very important level here, 89, 88, 90, 89 the figure. If we come out of the FOMC, we're above. Then we look at the S&P tomorrow. And regarding the S&P, do you want me to pick the screen for 5 minutes?
Yeah, go ahead, mate. Go grab it.
Okay. Just going to show what's happening in because this is one where we need to really pay attention to for the next 24 hours, really. So you have FOMC, you have S&P. Now the expectations for a cut have gone up a little, from a sub 30% to 30, somewhere between 35 and 40. I don't recall today. It doesn't really matter. But here we are. We are turning around very important levels on the dollar Swiss. Okay, it's the 61.8 of the whole end of the year dump. If the combination of S&P FOMC says, imagine that S&P cuts tomorrow, then it's really, I think then dollar Swiss is probably going to ramp up straight away to those highs again, the October highs, and that would only be completely reversing the year end. Still not, how should I say, still not putting the Swiss completely weak, because we saw a big ramp higher in the Swiss towards year end when the S&P was still buying Swiss franc. They stopped it. There's a bit of pressure from corporate Switzerland for them to cut, actually. So I am not going to rule it out. But now the expectations are coming very close to what I think as well. I think it's rather a 50-50 than what people may think. But okay, and I'm talking my book. But imagine that we don't. So they don't move, and the FOMC is not as hawkish as people may have expected. Then there's a bit of a risk that we go back into the lower 88s, even towards the 87.5 zone. I don't think there's enough weakness in the dollar, perhaps building to get much lower, but there's a possibility we have a revisit down to 87.5 before ramping higher. And then the other one, and I reduced it a little bit. I've actually reduced my positions on the Swiss quite a bit over the past 24 hours, because we never know, and there's always, even though if they really cut, it's going to be a case of where we can sell Swiss again, because it's probably going to go really, really hard. This one, we're coming into that zone, yeah? 96.75, 97 the figure, and as well, this and here, this is your year-end dump. in the Euro Swiss. Okay, so we are close to levels where we haven't done the year end, but not more. Yeah. Okay, we've gone out of the channel. Okay, but we will only haven't done the year end. It's not yet real Swiss weakness, you know. So I think if SMB cuts tomorrow, I really think we are going to see higher levels here, and by higher, it's probably 100, 200, could even possibly over time take us back to parity, and that's going to depend on what Jordan has to tell us. Okay, there is a press conference tomorrow, if I'm not mistaken. Let me quickly check. Yeah, there is a press conference on the SMB. So because they only meet every 3 months. Okay, so not moving now means that for the next 3 months they are not going to move at all, and that brings us then to a global June cut festival in June. But as I said, if they would cut now, that means that they are having ears to what corporate Switzerland is telling them. Okay, and corporate Switzerland is still not very happy about the Swiss levels, and then we can really move quite a bit higher. So that's what I had to say about the Swiss, and you just the sterling Swiss. You guys still hear me? Because because I've got the impression my internet is playing up a little bit. So this is the sterling Swiss. I think there, if we are still on our way to 114s, but be a bit careful here, I would say. There's this channel. We are holding the first one, but then there's the bingo channel below. 112, 15, 25 now is where we should really hold, if not 112.5, for this to continue higher. And then I think, in line with the rest of the pairs, if they would cut, then I think 114 is just going to be a psychological level, perhaps, but we could be on our way to 116. But first of all, they have to cut, of course. So that for the Swiss pairs. Yeah, for the rest, you know, the rest is very much in ranges still. Euro dollar, bit of small support around here, then the one around the 107.90, and I would say 107.60, 70 as well, if the FOMC remains hawkish, or is hawkish, back hawkish. That's a possibility. If we start to move back above 108.75, we may have a revisit of those low 109s, perhaps. That's the thing. I think it's 108.75 that we need to watch on the top side. But it's going to be all dollar pairs together, I think, tonight, perhaps with a bit of a asterisks next to the dollar Swiss. Wait for what the SMB does tomorrow. And with that, Ryan, back over to you.
Thank you very much, mate. I'll grab it back just quickly before we go, because I just want to have a quick look at S&P. Got my screen okay, mate?
Yeah.
Cheers. So, you know, this is another one you need to keep an eye on if you're trading stocks and S&P. We're sitting right up on these highs going into the Fed. And, you know, this again is one of those situations where if the Fed isn't hawkish, as the market expects, we're probably going to see a break through here if we haven't broken already. I was looking at this one, as you know, similar price action. We had a decent period of time between highs. We're still holding the highs. Had another little attempt yesterday. We're on it now. The price action is looking a bit bullish because the dip from that high really shallow. So this again could be a bit of a deciding factor. If we get a triple top up here after the Fed, then we're likely to see a test much lower. We might start breaking the trend of higher lows, because a triple top would indicate that resistance is looking pretty solid. So all you top pickers will have a bit more conviction to get in to that one. And as a long, I might look to tighten my stop up a bit just down below in case we are finding a bit more of a solid top up here. But if we break it, if we go through 52s, then we're probably on for our next leg of whatever journey this one wants to get on as well. And just quickly, gold is in a similar situation well, I'll say a similar situation. It's holding up, but it has started to change its pattern. It's now lower highs, lower lows. So, you know, when we had this last hurrah up near to 2200, since then we failed to get up to those highs. So this, you know, that's looking a bit more bearish at the moment. You might want to draw, some people might say it's a bull flag forming, who knows, but price action just saying that we can't quite get it back up to those highs, and we are seeing some lower lows. So maybe the tide's turning this one, but it's still pretty short term, just over the last few days, couple of weeks or whatever. I know our mate Dovish likes to look at gold, but yeah, again, if you get over the Fed, test up towards these highs, 2180s, 90s, and it holds again, that's probably going to see the sellers come in and then whack it back down to these sort of levels. So that might be a counter trade to look at just based on the price action. Right, that's it for today. Hopefully we've got you set up for the FOMC. One thing I did want to note, we were going to be making a special announcement today on the Face show. We've had to push that back a bit for a week or two. Just some technical stuff that we need to finalise to make sure what we're going to be announcing is all fit and raring to go. So unfortunately, there won't be an announcement on today's Face, but keep your eyes peeled for, we'll let you know well in advance when that's going to come eventually. And on that note, have a very good day. Thank you, K-Man, as always. Best of trading to all of you over tonight's FOMC. Stay safe, and we'll see what happened on tomorrow's show. Have a good one.
Cheers, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.